welcome to our special show, the Motilal Oswal 20-year wealth creation study. Now, the secret of wealth creation is to buy businesses at a price much lower than their intrinsic value. Now, lower the market value compared to the intrinsic value, the higher the margin of profit and the higher the margin of safety. Now, for every year, for the last 19 years, Motilal Oswal has been trying to cull out the key features of businesses that create value for their shareholders. Today we stand on the eve of the 20th report being unveiled, and I have with me the person who has been the author of this 20 reports, Raamdeo Agrawal, the Joint Managing Director of Motilal Oswal Financial Services. And to cull out from him the key philosophies and learnings of stock picking over the last 20 years, I have with me someone who has excelled in that art and science himself, Ramesh Damani.
Thank you,
veteran Bombay Stock Exchange dealer. Ramesh, okay, broker. Ramesh, actually, why don't you start this Q&A session? What is the best that you have seen of Raamdeo Agrawal in the 19 years of reports and the 20th wealth study which you've already gone through? What stands out that makes him an ace stock picker?
Yeah, well, you know, Raamdeo has covered various facets of stock picking over the years, and obviously I follow him very closely. But this year he's picked what I consider the holy grail of investing. We want to find mid-sized companies that can become mega-sized companies, because that creates enormous amount of wealth and creates a sort of bulletproof portfolio, if you will, over many years. In fact, Raamdeo, in your study you mentioned that smaller the market cap, faster the wealth creation. That's what you found in this study. But does that reflect the times, that this is an era of disruption, this is the era of entrepreneurship, or does that stand up historically, that smaller companies always create more wealth than larger companies?
Yeah. So actually, when you the companies, they go to the destination market cap from a base. So if you start from very small, say Infosys in 93 June, I mean,
it's 30 crores.
Just about starting the career.
Right.
At that time at 32 crores exactly, they did the market IPO, which was kind of failed IPO, then got listed at 50 crores, and today it is 250 lakh crores. At that point it was less than $100 million company in terms of sales. Now if they were growing at 100%, on $100 million, if you do 100% sales growth, you do only $100 million. Today they do roughly $1 billion more every year. Yet on a $9 billion, it's just about 11-12%. So the effort size is 10 times more, yet the growth rate is 1/10.
Right.
So you need that numerator denominator. So for a very high growth, necessarily you need to have a denominator which
small
is
base.
reasonably small.
Right.
You know, for the size of the opportunity.
But small caps, Raamdeo, are typically a graveyard for stock picking.
Completely.
Businesses fail.
Yes.
So you use a formula to filter that. Tell me about that.
Yeah. So we are talking about mid to mega this time, because last time the study we did, 100x study, that was kind of from very small base to very large base. Now it's a very nice story, but very low probability event. Very low probability event. Like 3 companies in 5 years will go from 0 to mega.
Finding 100 baggers, basically.
1,000 baggers, actually it's 500, 600 baggers in India.
What is the probability of even mid going to mega?
Yeah, so that's multiple times more. So that I'll explain you. Mini to mega means you're talking about, say, India is blessed with 3,000 companies listed. So what we are saying is top 100 companies being mega company, today whatever is listed,
right,
and that is 75% of the market cap.
Absolutely.
And you go across the time period from 95 till date, it's a power law. First 100 companies are 75% of the market cap. So literally you're talking about 3/4 of the market.
Right.
Then the next 200 companies, 100 to 300, that covers another 15-16% of the market cap. That's where you should find the companies which are going to go from this mid to mega, and then rest all 300 to 500 we consider as mini, and all 500 put together they cover almost 96-97%.
Those are the long shots. So
yeah.
let's talk about the mid cap area.
Yeah, so mid cap is where we...
You know, you normally speak about that QLGV, which is your formula.
Yeah.
Explain to us what exactly you mean by that, and is that the formula you apply to filter out from the mid as potential mega stars?
Yeah, so first is to look at the size of the company. where exactly you are hunting. So a lot of these large companies, they are very popular, they hog the limelight,
Yes.
but they are not the typical wealth creators. So typically, if you are a mid company and you remain in the mid segment in after 5 years or 10 years, you will make less than market return. If you are a mega company and you remain mega, you might again make less than market return. Okay, so what is important is to make a serious money of 35-40% compounded, you need to change the ranks, and the rank change happens when you go from mid to mega. So that's the aspiration of the investor. So what happens is typically stock picking starts with a story. You hear some stories somewhere. That's the reality of life.
Absolutely.
Okay, you
Some
can do
hypothesis,
some
some
hypothesis,
story.
some story. Somebody says this product is very well. He knows this management is very good, or this opportunity is like value migration. You read a book, you read the concept, and then you go and find a Page Industry or a iShare or a Infosys or whatever. So what is important is to start the story, but let the story be found in mid cap. Okay, or you run a screener.
So that is how you get your hunch. Is it not that you look at, you run an Excel sheet on ROE, ROCE, profit and revenue.
Yes.
And if there is a 4-year track record, you go and pick them.
No,
it's not as,
it's not that
cannot
simple.
be as simple as that.
It cannot be that simple. Then it is 100% mathematics. No, it doesn't work like that. So first is a story, or you also, some of the stories, they are found in the screener itself. You find in the screener, like rank is changing. Say a 800 number company is becoming 700, 700 is 600. There is something happening there. Then you go and find out the company, call up the company, what are they doing, and then probably then you look at, then the QGLP starts happening. Then you look for the quality of business, quality of management. This itself is 90% of the research. Once Q is taken care of, then look at the G, which is the mother of all the investing. The winners and losers are decided at understanding. Calibrating and valuing the growth, because what happens is growth is integral part of the valuation, whether it is a negative growth or positive growth or no growth, it's a growth. So you have to take a view what exactly is going to happen to that particular company's growth, and once that growth is, you have estimated the growth of the company, and then the next challenge is to understand what is there in the price already. If a 20%, you find a 40% growth company, but actually market is pricing 50% growth.
Okay.
In that case, even 40% growth is not going to make you money. So you have to buy 40% growth when market is expecting only 10% growth. Then you make a mega money.
Einstein's E equal to MC squared is simpler to understand, but let me break it down for you. One of the things in your 20th study you found that leadership, market, industry leadership is very important. How do you diagnose that, and give us some sectors where you see leadership happening for new mid-cap companies?
Is leadership not just about market share being the biggest in that sector?
So what happened was, we said, if you want to become mega company, let's figure out what exactly mega company means. How do they become top 100 companies? How to become TCS? How to become, why there are only 3-4 tech companies when hundreds of them they started in 1994 when the story started. So what it takes to become mega company is the leader. You have to be 1, 2, 3 of that particular business, however large or small that business is. So, of course, the leader companies have become mega companies. But how do you find leadership traits in the mid-sized company?
Exactly.
So there also, say, tire companies. Okay. Now MRF was even today I think 11,000-12,000 crores market cap. So it is clearly a mid-sized company.
Right.
Okay. So now it is your call whether can it become a mega company or that's a different question altogether. But you have a clear leader in tires in MRF. Or you look at say Symphony. Now Symphony is in coolers. It's a clear leader and it's still a mid-sized company. Say your Indigo. I mean, right day one, it's a clear leader of the market in aviation. Okay. Even Jet, I would say, is a leader. Now it was a hell of a less than $1 billion some time back. So whether you want to buy or not, that's a QGLP process. But you find a lot of leadership traits among the mid caps also.
But by definition, those mid caps would have to be moving from unorganized to organized, or having some disruption technology, right? That would give them leadership.
Yeah. So no, leadership is not because of that. The growth comes because of that. Say like Titan. Now Titan in 2003 was as an organized jewelry player. It was always a leader. It was not profitable or it was struggling with the new business model. That is a different thing. But the leadership traits were there. And today he has become clear number one in organized jewelry retail. So when you bought it, it was maybe 1,000, 2,000 crores.
So how did you identify him
much smaller.
Yes.
I think few hundred crores.
Yeah.
And from there to become 30, 40,000 crores. This journey we have seen it right in front of us.
That is actually easier to take as an example. It is retail trade. It's not rocket science. What made you identify that Titan could be a winner in the coming years?
Let me just correct it. I didn't identify. Rakesh did get it right.
Yes.
Yeah. So dear friend Rakesh, he got it right. But we are analysts only. We are seeing from behind. But now let me take a question to say Bharti Airtel. So when I bought Bharti in 2003, it was just about 4,000 crores market cap, 20 rupees for 2,000 crores market cap, 4,000, 4,500 crores. Even at that point of time, it was a mid cap. It was not a mega cap. And in 5 years, it became 50 times. But it was a #1 wireless company in the world's most celebrated value migration story. A country which didn't have telephones, they provided telephones in hundreds of millions in next 5 years.
From no connection to digital.
From no connection to, we have seen it all.
Yes.
Yeah, but when it first came, it was 16 rupees for a call.
Yes.
Why would you want to jump into it and believe it is a value migration story?
It was
16 rupees would have made it a very elite
It was
story.
no telephone to telephone. Price was another issue. It was no telephone to telephone, and second, telephone on mobility.
Okay.
See, you are sitting in car and you can call up anybody. So for businessmen, even 16 rupees was good enough.
You saw the future.
Yes, see, that's what is the key issue. That you could see the future, that this country will need millions and millions of telephone, and here is a company which has a network business design, which has a value migration, which has a leadership which is talent and kind of high energy leadership.
So it is the big idea, that disruptive technology or that outstanding technology.
I can
Bharti
tell these things because I've gone through this particular stock.
This conversation is extremely engrossing,
Yeah.
but I am told that we have to take a break. So Ramesh, Raamdeo, hold on to your thoughts. We will come back and ask you what were the highlights that you learned from the 20th year of study, as well the key takeaways from the last 19 years. All that coming for you in a minute. Welcome back. We have been looking at 20 years of wealth creation studies authored by Motilal Oswal. We have the author of these 20 years of studies, Raamdeo Agrawal, and to question him and get the best out of these 20 years of lessons, I have with me as my co-anchor Ramesh Damani, himself a veteran stock picker.
Do you see technology as a threat to longevity, that mega caps can't remain mega caps for more than 10, 15 years because technology disrupts almost every business?
But in last 20 years of study, I have realized that even when the technology onslaught was not that high, say in last 20 years, then also the leaders keep changing.
That's a static economy, a crony economy, as opposed to a
Let me
dynamic
ask you
economy.
one thing. What could be the 1995 #1 company?
In India?
In India?
Must be Lever.
It was Steel Authority of India Limited.
Okay.
13,000 crores market cap, by far #1 market cap company. Today it is struggling to be, kind of even in top 120, 130 companies.
Which actually brings me to the favorite question. Are there any characteristics of sectors where you will find the winners? Is it always difficult to find winners in resource stocks and more likely to find winners in retail stocks, because you will have brands in consumer stocks?
Yeah. So these are all point of time. The evolution of the economy is continuously evolving. The winners of the business are different. In 2000, it was the tech boom. it was by far, it just engulfed the whole world. Wipro was 3 lakh crores market cap for 3,000 guys working for them.
And made him the second richest individual in the world.
For a few days.
So at the current juncture, would you therefore think that renewable energy could be the next big thing? Would you look for that idea?
No, not now. Because my first filter is there should be a profit and profitability. And I should smell a lot of profit is going to be made. I must smell that profit. Say today some company is making 100 crores and I should smell a profit of 5, 10,000 crores. Then I'm willing to spend my time and buy them. And probably you are seeing that particular profit, so you go and buy. I'll not buy till I smell that.
Raamdeo, to finish off your formula, P is for price in the formula, and there is no substitute for buying a stock cheap enough. There's absolutely no substitute in this business. But you always favored secular story as opposed to cyclical stories. But couldn't cyclical stories be cheap enough that they can make good money? Maybe not fitting the L criteria, but definitely making a lot of money in it?
Yeah, it can. See, there are a lot of styles of making money. And some people are masters of cyclical stocks, some people are good at secular stocks. So I have tried cyclical stocks. Every time I buy it wrong time and sell it wrong time. So I stopped kind of trying on that.
Your sweet spot was
my
secular.
sweet spot is secular
Consumer facing, retail.
What I don't want to sweat
Touch
too much
feel.
B2B and all. So I love to buy B2C businesses,
Right.
leader businesses where bargaining power is better, terms of trade are better, and the scalability is very high. So like I used to hate aviation companies, but once the Indigo came, so it's a darling. So you
You told me once you'd never buy an airline stock. What changed your mind?
because of the business model.
Okay.
They have this company.
So it wasn't against airlines, it was against the practicing business models. Was it because the fuel price went down, so you looked at it again?
No, fuel price was one aspect of it, but second is the business model these guys they pursued. Their entire fleet is on the operating lease, so there is no load of the fixed cost here, and working capital they can always sell 3 months tickets. This thing, so they are literally working on negative capital employed, and they have a huge competitive advantage compared to other players in here, and other players are bankrupt. So it's and then of course the oil price is
It's a huge tailwind
amplifying right now. All the airline stock all over the world.
Raamdeo, 20 years into your study, the index was, Sensex was 4,000 roughly when you started, closer to 27,000 now. You've had unbelievable 9x. What do you know now that you wish you knew when the Sensex was 4,000?
Wow, I mean, I wish I knew all the findings of 19 studies then. I mean, the power of equity is so massive. I mean, when you see why we are doing this 20th study, we didn't understand the power of growth. I mean, where to find growth, where to search for growth, and how to calibrate. See, a 40% growth for 10 years can take you to sky.
You own the world, pretty much.
So, but India produces those kind of companies. I bought into, I mean, like Infosys happened.
We all
right,
have. It's been
Infosys happened right in front of us. We didn't know the mathematics of investing in Infosys.
Those kind of growths.
Yes.
Raamdeo, Ramesh, you'll have to end with giving something to our viewers in terms of how they should look for stocks. So now we are probably entering globally a secular, a low growth. Some people even call it secular stagnation. So to that extent, Indian growth will be suppressed. All the more reason why we have to look for those bright sparks of growth which will always outperform the market. Where should the young men and women look for that next big idea?
So first thing is don't bother about this global macro and all. Okay, just don't bother about it. Everybody will be wrong. I can bet everybody will be wrong. It will be a robust growth, fantastic growth. Look for your few companies' growth spots. For every action, there is a reaction. If the commodity prices have collapsed, what was built in 15 years, it is collapsed in 15 months, there will be a lot of companies which are benefited. Today, focus is on the companies which are destroyed. People are not focusing on the huge benefit which has gone to aviation or car company or paint companies, packaging companies. Nobody is talking about them. And you see the quarterly results. All of those guys, 15% top line growth, 80% profit growth. From where it is coming? It's all coming because of this $1 trillion gift from the oil industry. So there will be a lot of spots where there will be companies, businesses which will be prospering. One, because of this external factor, but I think the biggest magic is the entrepreneur, and particularly Indian entrepreneur, who is the first generation entrepreneur who does the magic of converting a simple 100 crores or 200 crores to billions. I mean, look at what Infosys has done or what Asian Paint has done. They started with literally $100,000 or $50,000, and today they have created a 30, 40, $50 billion empires with billions of dollars of profits yet to come.
And dividends paid out.
Dividends paid out. So I think we have to look for this opportunity. This is an exponential time for India. This is a point of time for India and Indian businesses.
Absolutely.
There won't be any dearth of growth spots or investable spots, but you have to work hard to find those spots.
That's 20 years of successful experience speaking, and I have with me on my side to question 30 years probably or 40 years of experience.
You tell
us, Ramesh, what should the retail investor look at in terms of the next
Let me
idea?
just give it a slightly different view, Lata, because I think it makes a lot of sense. Suppose there's a basketball game going on and the opposing team, which is real estate, bonds, whatever, have players who are 5 foot tall, and the equity team, which have players who are 7 foot tall. Which team would you bet on? Obviously the 7-footer. Now let me tell you why we are the 7-footers in the equity markets. For no other reason that the government is giving us the greatest handout they can ever give any industry. Long-term capital gains are tax-free in India. We are saving 30% tax. It's unbelievable what's that. Dividends are tax-free in India. That is what makes equities markets 7-footers as opposed to every other industry that has to pay 30% taxes. It's one of the great tax breaks we have. I hope first not only look at equities but also understand the power of equities, the compounding and the tax-free nature of that,
And
which will give us huge advantages.
And I think the patience, in equity, in real estate and all, people have patience for 15, 20, 30 years. In equities, people, which is a truly long-term asset, but people get tired in 1 quarter, 2 quarters, 3 quarters. I think that's where the game has to be different, where people have to bring patience on the table.
Again, don't look at price, look at value.
Yes,
Yes.
of course.
Ramesh, Raamdeo, we have to call it a day. But let me end this show with what Phil Fisher has said, and it's quoted by Raamdeo Agrawal. It seems logical that even before thinking of buying any common stock, the first step is to see how money has been most successfully made in the past. Now, can I give you a better reason to read all the 20 years of reports that Motilal Oswal has put out? That's it on this special show. Thank you for joining.